Hey guys, I hope you're having a good one. Today I want to go over the SPY and how to pick a strike price. I'm going to show you how to pick a strike price. I want to talk about flow. I want to talk about option strategies, covered calls, selling puts, and basically all the option fundamental stuff. So assuming you already know about options, how to buy them, how to basically implied volatility, volume, you know all the good shit. You're ready to start actually looking at different ways to trade options, different ways to make money with options. Now I'm going to be honest with you guys, I'm not fully 100% experienced with doing option strategies like the straddle, the iron condor, butterfly. I am pretty well, I like to consider myself pretty well knowledgeable about those strategies, but I will do my best to show you what I know and what works best for me as a trader. Now, what works for me as a trader may not work best for you, so it all depends on what style of trading you like, and once you find your style of trading, then beat it with a stick. So this morning, if you pay for the, how can I say this? If you pay for my callouts, then you might have seen me say, SPY is going to 425, and this is what we're hitting. So let's start from the beginning. Before I even look at options, before I even consider what options I'm buying, if I'm buying calls, if I'm buying puts, I gotta do a couple of key things. First things I gotta do is I gotta make my levels. So I'm gonna go to my daily chart. I'm gonna look at yesterday's high and yesterday's low. So SPY actually ran down today, but we made some money on calls. The high, the low. Now, if you noticed, yesterday we had gapped from yesterday's. We had gapped pretty hard yesterday. So that was pretty interesting. But yesterday's high and yesterday's low was at 416 all the way to 420.12. Pretty interesting. So let's look at the minute chart. And I'm going to mark my pre-market highs and lows. So I think I messed up right there. So once I marked my high and my low for yesterday, as you can see, we were bouncing between those ranges for the most part. So after yesterday, we ended at a high, and so we just traveled along our high, we broke our high, we stayed above our high, and I'm going to mark my pre-market high. 423.48. I'm going to mark it. And I like to mark my pre-market lows at 420.71. I just like to mark it just so I know how far we could theoretically fall within a day. And as you can see, we touched it eventually and just broke below it, and even our yesterday. So immediately coming off today, I knew that we had a very good tendency to stay above our EMA lines. So in pre-market, if you could see, we were above all of our EMA lines. We broke below it, we went above, we went below, we went above. We kind of stayed and trended above our EMA lines. As volume picked up, we showed a lot of EMA line supportage, and so we constantly trended up, staying above our EMA lines. When we broke down and we went back up above our EMA lines, so right here, market open, we crashed. We crashed down. It was very bearish. It was a move downwards, and our SPY was opened higher than what our yesterday's high was. So the SPY opened up high. The SPY opened up in the green. It opened up with good money movement. So seeing that, hey, our SPY is above what we think is above what yesterday was, and on top of that, our SPY is below our EMA lines, which right here it was below our EMA lines. So let me mark it for everyone to see. Right here, we were below our EMA lines. So I took the opportunity to buy multiple call options upon different strike prices. So let's actually talk about strike prices for a minute and why I picked certain strike prices. Now, I picked the 425 strike price, which although we never actually went into the money for, we got pretty damn close, 5 cents away from my strike. And I made really, really good money. Plus, I think I capped out at 92% or 97% gain on that run. So I picked 425 because the SPY likes to jump between 5% or $5. I'm sorry. The SPY likes to move within $5 increments or $4, $5 to $4 increments. So I picked 425 because over here, previously, we had seen where this candle was heading, we had seen levels between, I believe it was 424 and 427, which is this one right here. This peak candle topped out at 427.37. So those were my levels. Those were going to be my levels. So I was thinking anywhere between, 420 and 427. The SPY likes to move within $5 increments. So once it breaks above, let's say 424 was a key level, because if we broke 425, we'd start to try to consolidate between 425 and 420. And if we broke 425, we'd go from 425 to 430. We'd consolidate between 425 and 430 levels. It's been consistent that we consolidate within a $5 increment. So even if we look at 415 on the dot and then 410, oh, that one didn't mark. Mark it at 410. I hate this. But basically, as you can see, there was consolidation between 410 and 415. Now, it broke above and below it a couple times, but it mostly stayed within this area. Now that we broke above 410, we went from 410 or 415. We broke above 415. When we broke above 415 and gapped up, we saw movement between 415 and 420. Today, we saw movement between 420 and 425. That's where you kind of see it. Now, that was a lot of technical analysis, and all these lines are probably making it confusing, but when you get into a stock, know the stock's levels and where it would bounce between before. So we're going to look at another stock in here in a bit, just to show you how I pick my strike price on that stock before, but the SPY is pretty common. I want everyone to know how to pick a strike price on the SPY. So let's go back to the stock for today. So knowing that the SPY can be anywhere from $420 to $427 with a $5 change increment, I was going to assume 425, so I picked the 425 call option. Now, there was another indicator on the 425 call option. It's called flow. Now, if you look at the volume, you notice that the 425 call option had the most volume compared to any other option. The 426, the 427, the 428 had significantly less volume than the 425. It had 237,000 option contracts being transacted today. Now, the 420, 421, 422, 23, and 24, they all had significantly high volume. However, the 425 had the most volume. And we saw a huge shift into the 425 call when we were rallying up. Now, we opened down, and as you can see, doing some technical analysis on the stock price, on the stock chart, I said, hey, this isn't true, this isn't right. We're supposed to be above our EMA lines. We're supposed to be doing great today. We opened high. We're looking for a run. Now, yes, that doesn't always happen, but a majority of the time it happens. Majority of the time, things go how you plan it. So as we ran down, we ran up pretty significantly high. And during this price range, from 422 to 424, I think we ran, well, how much? We ran $7? No, we ran $2. We ran, yeah, about $2, 0.64%. Very interesting. I didn't see it like that before. I'm trying to make sure my levels are right. So we were below our EMA lines, and knowing where we're going to go, I saw 425 as my strike price for my option that I was going to play. Now, I did play 427, 430 because there was a lot of volume in them and they were cheaper contracts. And as we started moving up, they gained a lot of value because of momentum. Momentum likes to drive the price of options. So options are extremely overpriced in the morning. So when we took this dump and I was like, hey, I think we're going up again because this, and this, and this, and I looked at the options and they were cheaper, I bought them. So immediately I saw the 425 start increasing in volume on this side. I didn't see the 426, I didn't see the 427 options increase in volume. Rather, I saw the 425 spike in volume the most. So I went in on that spike of volume. And we started riding up. As we were riding up, there was more volume. As we got more volume, there was more momentum. And more momentum meant more dramatic movements in the price of the option. Now, as you can see here, the option almost doubled within this time frame because we were just on such a constant stream of upward movement that we made so much money on the SPY. The contract moved incredibly insane, incredibly fast, incredibly violent, and when we started having this movement down, that's where we lost most of the momentum on the option. So this movement down kind of killed a lot of the option pricings because it killed a lot of the momentum. And the second we actually broke down here, we had this breakdown, I saw an increase in the flow of 420 puts. So all the way from 424.70, I started seeing that the 420 put increased in volume. So now the money switched from the 425 calls with 237,000. All the money started switching over to the 420 puts. And when you know it, 420 puts ran into the money. It went actually all the way down to 419. We actually ended 420.12. So pretty crazy. The 420 puts actually landed people in the money. So flow is a great indicator. Now, it's a lot harder to predict a breakdown on a stock than it is to predict a breakout on a stock. There are some indicators, consolidations. Like right here, we consolidated. So we're probably either going to see a break up or a breakdown tomorrow. Usually that's how it happens. You know, right here we consolidated. Consolidation just means kind of trend sideways. So right here we trended a bit more sideways than usual. Instead of rather going down, we trended sideways. And then we had a breakdown. Right here we trended sideways-ish. And then we broke down. But then we started rallying again because the end of the day. Right here we consolidated. Right here we consolidated. And then we had a break up, which got rejected, broke down. So, yeah, guys, just that's kind of how I picked my levels. Now, looking at NVIDIA, that was a stock I played today, NVDA. NVIDIA did pretty good for the most part. It followed the SPY and it ran harder. NVIDIA is really good for running hard in the mornings. First thing I'm going to do is I'm going to mark my high, I'm going to mark the low. Now, NVIDIA was pretty tricky to pick the strike price. So I went for something with, you know, good volume. I went for something with good movement. I looked at the flow. I usually do the NVIDIA $200 calls. Now, today I didn't do that. Today, instead, I rather did the 190 because when we started to rally up, I saw an increase in volume. So we ran down. And then once I was like, hey, this isn't right, and we ran up, I saw an increase in volume. Actually, at first I saw an increase in volume. Oh no, it was the 190. I saw 190 increase and spike heavily in volume, so people were predicting it to go to 190. We actually went to 187. We went to 187.07. So this one was actually closer to money, but everyone thought this one was going to be more volume, more violent movements, a crap ton of momentum in the stock today. And then we saw a breakdown. I actually didn't play puts on video, but if I had to guess, it was probably going to be, not even looking at it right now, probably going to be somewhere in the 170s, 180s. I'd say 180s to 170s would be the highest. I mean 170. Yeah, no, sorry, 180. It was 180. That was the highest. I actually kind of find it cool that the 175 actually had more than the 177. That was that's kind of interesting to look at. But once again, guys, like the volume kind of shows you where the stock's going to go, and people are, options like to move their price way before something happens. So if you ever wonder if a stock's going to go up or down, I would look at the price of an option, and if the stock's going down and a call option still increases in value, you better get your ass on the call, because the stock's about to move high and people are willing to pay more to get on this, what they think is a dip. So just putting that out there. Now let's look at some option strategies. Now when it comes to the world of option strategies, basically you got to know a call. Let me type it. Call means up, put means down. So let's look at a couple scenarios, shall we? And I'm actually going to grab a pen, and I'm going to try to annotate it for the first time. Excuse my bad drawing. Let's do a line. Black. Okay. So this is a stock price line. It's going to look so horrid and crooked. I'm so sorry. So let's pretend that the stock is going to go up. So if the stock goes up and it just moves up, that means I would want to call. Now let's say the stock decides to move down from the same area. I would buy a put. So now that we've kind of basically gone over basic terminology that you guys should know, let's go over what a strategy is. So let's pretend Timmy here, let's pretend Timmy has a stock of SPY. Actually, let me go ahead and type this out. So let me type this out. So Timmy has 100 shares of SPY at 420. At 420. Well, let's say Timmy expects the SPY to open down tomorrow. Let's actually go ahead and title this. I'm going to explain covered calls. I don't know how I'm spelling covered right. We're just going to put cover. Cover calls. So a cover call is selling call options to protect your position from losses, or to make money on the downside. So when you do a cover call, you're selling a call option. You're selling calls because you think the stock's going to go down. And how can I put this better? In order for you to sell a call, in order for you to sell a call option, you have to have 100 shares of the underlying stock. So let's say Timmy invested in SPY because that's in his 401k. He has 100 shares of SPY. That's 4,000. Oh, it's actually 42,000, I think. $42,000? Yeah, that's $42,000. Damn, that's a lot of money. So, Timmy rich. Anyways, I'm getting off track. Timmy regularly invests in the S&P 500. So he has 100 shares right now, and he knows the SPY. He's like, hey, I heard some bad news about our economy. I want to protect myself, but I don't want to pull out of the S&P 500. I still want to buy shares regularly, and I want to make money on this downtrend, but I own shares. I can't short the position because I still own these shares. I don't want the stock to go down. I know it's going down. I own shares, and I don't want to sell my shares. That's kind of the predicament you are. Now, if you know a stock's going to crash, sell your shares. But Timmy's confident the SPY will recover within the next 9 to 10 years, and he's comfortable with this downtrend that he's about to experience. But he still wants to see money and growth in his account, so he's going to sell calls. You can only sell calls if you have 100 shares. So go back to my annotation. What Timmy's going to do is, let's draw a line. Timmy's going to sell a call option, and whether, let's say, the stock moves down. Oh, damn. I erased that. The stock moves down. The stock moves down. That's a bad color. I need to learn how to use this better because I suck at this. Here's the line. Now, Timmy decides to sell a 420 call option, and let's say the stock drops down all the way to, god damn it, I keep clicking on the line. Red, the stock drops down. It drops down to, let's say, $410. Well, since Timmy sold the 420 call option at, let's say, $3.72, he sold it. His account got credited $372, and then Timmy decided to buy back the option at, let's say, $1.30 per share. So now from that $372, he was able to buy back the contract at $130 per share. So he was able to pocket a $242 difference. So on this $10 drop, he was able to save. He made $242. That $242, he was able to buy more shares, more SPY, lower his average, and then Timmy expected the SPY to go back up within the coming months. Let's say this next week the SPY ran up, Timmy was back in the money, he had the $242 he made from the decrease in the SPY, so he was able to protect himself. Now, let's say the scenario, Timmy decides to sell a call option. Let's get a line. Timmy decides to sell the same 420 call option at, let me go ahead and write this down instead of just drawing it. Timmy decides to sell the same 420 contract at $3.72. Now, realistically, if the SPY dropped $10, the contract would be worth pennies. Or worthless at all, and Timmy gets to keep the full $300 something. So let's say Timmy decides to sell the $372 call option, and it went from $420 all the way to, it increased, went to the moon, all the way to $430. Well, Timmy actually sold his call option. The call option increased in value, and 9 times out of 10, whoever bought the call option from Timmy, more likely is going to exercise that option now. Timmy is now forced to sell 100 of his shares at $420. So Timmy made no money, but Timmy also lost no money as well, because he sold 100 of his shares at $420, and he's still able to keep that $372. It's just now he's out of his shares because he sold the call option. So he made $372, but the stock went up $10 per share. 10 times 100, 1,000. So he made $372 off of the 1,000 he could have potentially made. Now that's kind of how that works. Now, obviously, in the more extreme scenarios, the call option could expire out of the money, and Timmy gets to keep the full $372. So how most people play this is, let's go back to the line scenario. Most people won't, if they buy 100 shares at 420, they're not going to sell a 420 call option. They're going to sell a 420 or 430 call option, something that's out of the money. Now, closer to the money, you're more likely to pocket more money from that. More likely. It's more risky though. So, say Timmy decides to sell a 425 call option. 425, or well, let's say he sells a 425 call option. He sells the 425 call option at $2.50. I'm pulling these numbers out of thin air, guys. It's not accurate of how much these are. So if you know anything about options, it's not $2.50. It's actually $250. So Timmy decides to sell the 425 call option. Now, instantly, Timmy is going to lose 100 of his shares as collateral, but his account pockets $250. He gets $250 for selling that call option, and all he has to do is buy it lower. Now, let's say the stock goes from 420 and it increases and increases and increases, but it only goes to 424 after a week, because the date to expiration on this contract, let's just say it expires, date to expiration in 4 days. Now, time is also a big factor. Now, if it was supposed to reach 425 in 181 days, this contract might be worth $3,000 or $4,000, whatever you want to look at it at. But it expires in, let's say, 4 days. It's $2.50 for 4 days of time. But after 4 days, the SPY only hits 424, making this 425 call worthless, because no one's going to want to buy 100 shares at $425 when the actual 100 share value is $424 per share. The contract, it went up, but it expired. The contract expires outside of the money. It never hit 425. So Timmy got to keep his 100 shares plus the $250 he sold the contract for. Now, if let's say it went to 425, the SPY went to 425, Timmy is forced to sell 100 shares at $425. Now, he still makes money on his shares. He makes a $5 difference off of 100 shares because he bought them at 420. Timmy bought 100 shares at 420. Now he has to sell them at 425. 425 times 100, or $5 times 100 is $500. So he makes $500 on top of the $250 premium he sold the contract for. So now Timmy is up. He's made 500 plus 250. That's $750. Timmy made $750 from selling a call option, and the call option actually went into the money. Now, he didn't lose money. He just had to sell his shares. If, let's say, the SPY went to $430, Timmy has to sell 100 shares at $425 because it went all the way to $430. You know, he could have sold his shares for a $10 gain, but now he had to sell them for a $5 gain each. That's the predicament you play. That's the gamble you risk. You don't get to sell your shares at a higher markup if the stock decides to go up instead of down.